Thank you. The reason why you're using, and you're going to be learning about stocks and bonds, which are basically what are called underlying assets. But in most cases, if you're going to be a trader, or if you're going to be working in treasury or finance, you want to leverage your capital. The way that you leverage your capital is through the use of derivatives. It's too expensive to buy the stocks and the bonds. So why don't I just use the forwards and futures and the calls and the puts on the futures, and now I can put up like $5 and control $50. That's the goal. If I'm right in the direction in which I forecast, if I only have to put up $5, but I can control $50 worth of the assets just by controlling them, and I'm right, I'm going to make 10 times my money. Okay, that's why you use them. And these instruments are used not only for trading purposes, for speculation, but for hedging purposes. And I'll give you some examples. So let's just do, there's only two directions in which prices can go, up or down. Okay? In this case, it's down. So we forecast stock, bond, oil, whatever, prices to fall or to drop. We are tracking 3 indexes. The indexes are basically tracking the prices of those financial or real assets. You would write forward contracts if you think that the prices are going to go down. And when you write a contract, you basically write it and somebody buys it. And when they buy it, they give you money and it goes in your pocket. Okay? When you buy a contract, I got to put money out. But somebody's writing the contract, I pay them and they pocket the money. Okay? So you can only be on two sides, either the writing side or the buying side. So if you think they're going to go down, you're not going to buy a forward contract. You're going to write a forward contract because you think it's going to go down, the other guy thinks it's going to go up. And if it goes down, they're screwed. If it goes up, you're screwed. Sorry. So you write forwards, write futures, and I'll get into the details of this, but I'm just doing the mechanics of the trades. You're going to write call options on futures, or calls on futures, because I shortened it, and you're going to buy puts on futures for the indices. For the exchange traded funds, you're going to sell short, which is stock terminology. You're going to buy puts, which means you make money when they go down. You're going to write calls, which means you're going to make money when they go down. These trades for the ETFs, since they're shares, just like stocks are, that both trade on an exchange, you're going to just copy this and bring it over here. So for the stocks, as they're going down, you're going to sell short, buy puts, write calls. So for rising prices, not increasing prices, but rising prices, you are going to go long. You're going to go long the market. Which means you're going to buy the forward contracts, buy the futures contracts, you're going to buy the call options, because you make money when prices go up when you buy calls, but you're buying the call options on the futures contracts that are basically referenced to the indices. That's why they're called derivatives, because you're buying a call option, which is a financial contract, a security, that's based on the futures prices, that's based on the index prices. That's why they're called derivatives. And then you're going to write put options, because you make money when prices go down. When you buy a put, you make money when prices go up when you write a put. It's just the opposite. So if you understand the logic, you can just reverse it. So you're going to write puts on futures. For the ETFs, you're going to buy the stock on margin. Our company does not buy stock outright. It's too expensive. My returns, when I buy the stock, when I just buy the stock, my returns are linear in most cases. When I buy on margin, I'm basically putting up maybe 10, 20% of the equity, just like if I was buying a house, and then I'm borrowing the rest from like a bank. But the bank is called a broker-dealer. The broker-dealer will lend me money, so I have to put up just a little money, and they're going to lend me money, and I'm going to buy and control the stock. That's called leverage. Okay? So it's just like borrowing on a mortgage on a house. I got to put up 10 to 30% of the equity, and I'm going to borrow the 90 or 70% of the mortgage from the bank. So I'm going to borrow money from the broker-dealer, to buy these shares, and I'm gonna put up a little equity. They're not gonna give me 100%, you know, of the loan. I gotta put up some capital. I gotta put up some capital in a margin account. And if the trade goes against me, I'm gonna get what is called a margin call. I'm either gonna have to put up the money, or they're gonna take the shares and sell it.
So if you leverage your trade, you can get screwed though.
You can
Stock
totally
goes
get
down.
screwed. When you leverage the trades, the curve goes like this. So when you leverage, your return on equity is exponential. But if it turns against you, your losses are exponential too. And the broker-dealer is going to be all over you. And they're going to say, hey, you just hit your maintenance margin. You got to put up more money. If you don't put up more money, we're going to sell the securities and we're going to keep the money. It's that brutal. That's the way it works. So our company has hired some really smart people, and I have really smart people working for me, and they're really good at forecasting prices of these asset classes. So I want to take margin. I want to take risk. I want to leverage, because you guys are right all the time, okay? So in a rising price environment, I'm going to buy on margin and use leverage. I'm going to buy call options, and I'm going to write put options. And I'm going to do the same thing for the stocks. It's just replicated. Okay, any questions on that? Any questions on the trading logic that we're going to use for the derivatives? No? Everybody get it? Okay. If you don't, then you can review it, because we're going to have it up there. So I want to do kind of an introduction to